This is where bonus depreciation changes the game. With bonus depreciation back, you take that entire $900,000 write-off and you take it on year one. You just got yourself out of paying taxes for the next 4 or 5 years due to that one segregation study. We always say either buy till you die. You're essentially getting all of the money back that you put in, which means almost every year you can go buy another building and continue to do this. Let's say you've made $150,000 and you have $50,000 sitting there that you're like, I know I'm going to have to pay this in taxes. They make $16 for every $1 in depreciation they give me. So if I take $1 million in bonus depreciation this year, the US government made $16 million. There's actually AI-based cost segregation study companies now. So you just give it to them and they run it through an AI platform and give you a thing and then typically put audit protection on it. For a building like most of my apartment buildings, I want boots on the ground. I want them walking everything. So they fly out, they walk all the units, they do a really comprehensive study. It costs me typically about $7,000 or $8,000 on the buildings that I'm doing it. But this is what happens. We talked about 27.5 years as your write-off if you did nothing. If you do a cost segregation study, what they do, what the study is, it's taking into account stuff that is not going to last 27.5 years. So things like wearables, think lighting, HVACs, carpets, roofing, windows, appliances, things that need to be replaced. So they're going to take that value. And typically the rule of thumb is it's about 1/3 of the property's value. So if you buy a property for $2.75 million, remember you get that $100,000 write-off each year. If you do the cost segregation study, again, keep in mind they're going to factor land out of this, but I'm not trying to make it overly complicated for everybody. It's about $900,000 that's going to come out of that cost segregation study. And before the tax laws changed, which with the big beautiful bill that's just got brought back, that's what we're talking about today. As those tax laws were changing, bonus depreciation was going away. It's what the tax law just brought back. So right now, if you did a cost segregation study, that $900,000, you would get to take that across a 5, 7, or typically 10-year period. So let's say it was a 10-year period that you were going to take that depreciation on. Remember we said you were going to get $100,000 a year? Well, now you're getting another $90,000 a year for the next 10 years. So now you're taking $190,000 write-off because of that cost segregation study. This is where bonus depreciation changes the game. With bonus depreciation back, you take that entire $900,000 write-off and you take it on year one. So you buy the building at $2.75 million, you run your cost segregation study, you made what? We said you'd probably make about $50,000 off of that building with your down payment, but you take a $900,000 write-off. So now you got $850,000 to take against all of your other income. And if you didn't make another $850,000, it just moves on to the next year. So let's say you're making $200,000 a year. Well, great. You just got yourself out of paying taxes for the next 4 or 5 years due to that one segregation study. Now, if you're on this call and you're thinking, man, I don't have $2.75 million or $600,000, right? Scale it wherever you can scale it. I don't care where you have to be in your price point. But in that same example on the $275,000 house, you still would have taken a $90,000 write-off on year one. So think about that. On that $90,000 write-off, if you made $100,000 for the year, you don't pay any taxes. So think about that as a scale. I'm doing it at a level of, $4 million, $5 million, $10 million properties, and it's getting me out of $1 million in taxes at a time. But if you're on a smaller scale and you say, well, I make $70,000 a year, $100,000 a year, $150,000 a year, $200,000 a year, you can still take these smaller properties, whether it's $250,000 rentals, $300,000 rentals, maybe $500,000 duplex, whatever it may be, and you can still take these bonus depreciation studies and then get out of all of your tax basis for the year. Now, let's think about this. We said, how much did you need for the $275,000 building? About $650,000, something like that, give or take, depending on your down payment amounts. So think about this. How much in taxes do I save by not having to pay taxes on $900,000? You are likely getting slammed for probably 45% of that money. money. So the reality is it's probably about $400,000 to $450,000 in taxes you save. But remember, what did we put down? We put down like 600, 650. So if that's the case and we're going to put down 600 grand, but we're going to save 450. And remember, the building's going to make us 50 to 100. By the end of year one, we got $500,000 to $550,000 back of that $600,000 to $650,000 we put down. So effectively, that 1 year bonus depreciation, and again, you can scale this down, do it on a $300,000 house. You're going to take a $100,000 write-off. It only costs you 60 grand to buy the house anyways. You're going to save $50,000. You just need 10,000 more, which you got from probably the cash flow, and then you buy another one the next year. So you're essentially getting all of the money back that you put in the bonus depreciation on tax write-offs, which means almost every year you can go buy another building and continue to do this. And then remember, you're only bonus depreciating a third. So at the end of year one, in that example, remember, I still have the other $2 million left that I hadn't segregated, right? That's just standard depreciation. So instead of taking a $100,000 write-off, I took my $900,000 up front, but now every year after that, I'm still gonna get about a $60,000, $70,000 write-off on what's left. So now every year, think about how that compounds, because you're taking the bonus depreciation, but then the next year, you're gonna take your bonus depreciation on the next one, but you're also gonna take that 2/3 that was left on the first one, which means in 5 years, you got 2/3 on 5 buildings that are still depreciating regularly, but you've taken a bonus hit every single year to buy that next building. So just think about how that adds up. I'm buying 2 or 3 a year. So keep in mind, if I'm writing that off and it's giving me enough to go buy the next building next year, in 10 years, if we've got 20, 30 buildings, all of that 2/3 that's left, now I'm just not paying taxes on what's left, but the bonus depreciation is what let me purchase all of those buildings.
If you take that bonus depreciation in year one, is there any stipulations to that? Like you can't sell the house for a certain amount of years, or is that just with the regular depreciation? Because I know depreciates for 27 years. So you have to keep it for 27 years?
Now, here's your issue with all sales, whether you bonus depreciate it or whether you take standard depreciation. The second you sell that building, whatever depreciation you've taken, whether it's in 2 years, 1 year, 5 years, 10 years, 15 years, whatever it is, they're gonna have a payback. So what they call it is they call it a recapture, and that recapture is gonna light you on fire. It's not as bad as standard taxes, but it's not good. So we always say either buy till you die or just do at least a 1031 into the next property. So whenever you want to get rid of something, don't ever realize the capital gain, just 1031 it into something else, and then all of your recaptures don't get done, and then you kind of reset everything. Now, if you did a bonus depreciation study, we're getting a little complicated here, but I don't mind it. I like getting complicated, just don't like lose everybody. The reality is if you do buy that next building, that bonus depreciation factors in still. So you don't get to take that next million again, if that makes sense. But if you're buying up and you're buying bigger, it doesn't mean that you shouldn't still necessarily do a bonus depreciation. Obviously, you'll talk to your CPA about it. Is it worth doing the cost seg study again? But the more you steamroll it, you are taking that basis and you are putting it into the new building. You're not going to get to take that million again. If you wrote off the 900, it's going to go into the next piece and they're not going to let you rewrite off that million, but you should have bought bigger, which is going to then give you another basis to take anyways. But the second you sell and you don't 1031, you're doing a recapture. And I think the long-term recapture fee is like 15% on the tax side of things as far as like a gain. And then they hit you for other stuff as far as income taxes and stuff like that too.
Yeah, I've read on the cost segregation, it can be up to 25% now. I haven't clearly figured it all out, but I think you're right on the taxes, 15%, but I think on a cost seg, it might be up to 25, depending on what it was.
So the reality is don't do it. And then the thing is you die at some point and then you pass it on to your heirs and then it resets for them. So if you didn't know this, when it goes to your heir and you pass it on, they could actually technically sell it. And if the profits are less than, I think, 15 million, like inheritance tax doesn't kick in until I think 15 million, if I'm not mistaken. So the reality is if you have a $50 million portfolio, and for, you know, some people, y'all may be saying like, there ain't no way I'm ever gonna have it. And I hope all of you do, by the way. Like I'm buying stuff at a rate where like I hold $42 million in real estate now and just multi, but I have partners with that. But I still think, all right, I've been doing this for 5 years. I'm 37 and I'm not gonna stop, and we're only gonna buy more and it's only gonna buy up more. So like in my head, I'm like, mathematically, there's no way we don't have a couple $100 million in real estate at retirement. But even if I only own half of all of that and I've been refinancing forever, the reality is to sell it all and pull more than $15 million, like that's a big deal for anybody, I think. So the reality is most of you will likely never be sitting on enough equity. And again, it's not because I don't believe in you, but I also believe in the strength of this strategy. And this strategy would say we don't sell. And if we want money, we refinance it out. And if you're refinancing your buildings like a bank, you're never paying taxes on those refinances either, which means you're refinancing till you die. And if you sell, you're 1031ing until you die. And then whatever equity's left, 15 million and under, not only do your heirs not have to pay taxes, but I think the depreciation resets on the transfer too, if I'm not mistaken. Don't quote me on that because I hope I'm not close to death. So I haven't really looked into the logistics on that, but I do think that their actual depreciation, they can start depreciating again. So all of that is things to keep in mind. And I will always keep selling and resetting so that I always have something to depreciate, because otherwise in 27.5 years, if I don't sell anything, I run out of my depreciation basis and then I'm just paying taxes on all of that rental income. But if I can sell it and get into another loan and get into something else to depreciate, then it's going to pull my tax basis down, which is what I want.
At the end of the year, when the CPA is like, oh, you have a balance of $6,000 that you owe, does all this depreciation help that you don't have to pay that?
Correct. Yeah. So if you owed $6,000, you only owed on like $10,000 or $15,000 worth of income, because that was probably the taxable basis that made you owe that six. Then if you were depreciating like a $275,000 house, we said would give you about a $10,000 standard deduction anyways, without the bonus. So that $10,000 would go towards what you probably owe about 40 some hundred in taxes on, and now you don't have to pay that 40 some hundred. But if you bonus depreciated it and it gave you 90 and it was 15 grand that was being taxed where you're going to owe that six, well, now you don't owe the six and you're still left with 75 grand for next year, which means that next year it's another 15 or 20, then you don't owe the six again. And then the next year you don't owe the six again, and you're just going to carry it forward.
Okay. So that's why a lot of people invest in real estate, right? So they don't have to pay taxes.
Yeah, because think about it. If I buy a good stock and I put 100 grand in it and I double my money and I have 200 grand, and then I'm like, you know what? I'm going to buy another stock with that, and I sell it, what happens? I get taxed immediately. That $100,000 basis, I'm now going to pay a long-term capital gain on if I held it for long enough. And that's still, I think, 15%. So I'm still going to get taxed on that money. Whereas with the real estate, not only can I sell it and not pay taxes on that 200 grand when I put it into the next property, but they're also saying, oh, that 100 grand you invested, we're just assuming that stock's not going to be worth anything in 27 years, which we know isn't the case. And so we're going to let you write off that 100 grand while you do this. So while this 100's making you another 100, we're going to let you write off $5,000, $10,000 a year out of it. And the reality is, why does the government do this? Well, the government doesn't have to now provide housing to everybody. They're not having to provide jobs to everybody. That is capitalism. I'm not a political person, so please don't take it this way. But when you hear like people like, oh, I hate landlords, or I hate this, or I hate that, and they're just money grubbing whatever, and all they do is, right? No, the reality is, if the government had to provide all of the housing and all of the jobs and all of the food and all of the whatever, we'd be stiffed. So what do? They give us the tax code and they're like, hey, please use this, because what have I done? Well, I have 301 apartment doors, which means I've given 301 families housing. I give a management company hundreds of thousands of dollars in management fees. We have debt on all of that. Let's call it $30 million in debt. So think about what the bank's making in interest off of us. Think about what they're getting off of us. All of the taxes that are being paid by all of those 301 families that live in those properties, the managers and the taxes they're paying on the profit, what the banks are paying. Oh, don't forget our grounds need management. So we've got landscapers and we've got handymen. Oh, we've got turnover. We've got to get people to paint. We've got to put in kitchens. We've got to fix these things up. Oh, we need a new roof. We need new windows. We need capital X expenditures. Oh, we're paying utilities to the counties and the cities. So all of this revenue that gets generated by me, the landlord that they hate because they think I'm getting rich off of their backs. Do you know what the U.S. government makes on every dollar in depreciation they give little old Jared? They make $16 for every $1 in depreciation they give me. So if I take $1 million in bonus depreciation this year, the U.S. government made $16 million. That is not a guess. That is a fact. If you look up the book Tax Strategy or Tax-Free Wealth, like the 7 strategies of highly wealthy people, it goes through everything. It goes through land write-offs, it goes through energy write-offs, it goes through real estate write-offs, and it breaks down like the 7 top write-offs and why they're in the tax codes, and it breaks down how much money the U.S. government makes off of each one of these write-offs that they give it and why they give it. And then the other thing that you guys have to keep in mind is like, what's the real world use for me with this right now. So think about how many realtors are on this call right now. You have 21 of you guys listening in. How many of you have sold enough this year where you've made a good amount of money and maybe you haven't prepaid your taxes? Maybe you're not running like an S Corp. You're not paying a monthly tax or quarterly tax, and you're just putting 30% of your money away. Now think about a real world use. Let's say you've made $150,000 and you have $50,000 sitting there that you're like, I know I'm going to have to pay this in taxes. Well, between now and the end of the year, you took that $50,000 and you bought a $250,000 Airbnb at Wintergreen or a ski resort or a lake or just something in the city that you can Airbnb, something that you want to use yourself. Well, what is that bonus depreciation going to do for you? Well, if you bonus depreciate, you're going to get about what, $75,000 back? Just buying that property just took half of your tax basis off. Now, don't go buy a property and then not have the money to pay your taxes. That's not what I'm saying, because then you're stiffed. But if you had a bunch of cash sitting there, wouldn't it be smart to just go buy a property and get out of paying half of those taxes? And again, I'm using that as one example, but you could just be sitting on a bunch of cash. You could be sitting on 200 grand right now and your CPA is like, hey, you're gonna have to pay 100,000 in taxes. And you may ask them, well, what happens if I went and took 200 grand and I put it into a property and cost segment for the year, right? Oh, well, then you wouldn't know anything. Maybe it costs you more cash, but now you have an investment and you got a depreciating asset and you have another cash flow piece in your life now that's making you money. So for me, I'm already buying up the apartments and taking these bonus depreciations. But if I wasn't, then I would be looking at my tax basis and being like, well, dang, if I'm gonna owe 500,000 in taxes or 800,000 in taxes, regardless, what can I do with like $1 million right now to not have to do that? Because a lot of you are just running the wheel. You're just selling houses, you're paying the taxes, and then what happens, right? You're just writing everything off, which that doesn't really help you either, because some of you are probably being real generous on write-offs that may not even be legitimate write-offs. But then what does your tax return show? Oh, well, I didn't make any money last year. Okay, great. Well, then how does that look when I want to go get a loan, right? Not great. If I made 150,000, I wrote off 150,000. I'm like, I don't pay taxes. Well, great. You're also not ever financing anything. Whereas with bonus depreciation, they put that income right back in on your taxes. So that I can write off all of my income, not pay any taxes. And if I have $2 million in income on my tax return, but I wrote it all off, guess what the bank says? The bank's still like, well, you still made $2 million, because the bonus depreciation doesn't count like a normal business expense, like it would if you actually were paying a car payment out of a business or advertising out of a business, or the things that actually pull your income down. It gets rid of your tax basis, but they put it back in to the tax return if you're actually trying to loan with that income. Thank you so much for tuning in to one of our weekly training calls. Obviously, you caught the recorded session, but if you're interested in catching any of our live sessions that we do them typically on Mondays. I'm going to put the link below. So if you want to join any of our trainings live so that you can participate, so you can comment, ask questions, feel free to come. This is for our EXP group that we have here, our Omega group of agents, but it's open to anybody that wants to join, really. So if you're looking for coaching, if you're looking for training, feel free to hit that link below, and we'll see you on one of our live calls.